Hey everyone, welcome back to the channel. So this past week, billionaire activist investor Bill Ackman announced a huge new position in Uber. He bought $2.3 billion worth of the stock, which represents almost a 1% ownership of the entire business. And this really sticks out to me. Not only do I really admire Bill Ackman as an investor, but I've also been studying Uber for the last 6 months. And Bill Ackman was a day one investor in Uber. So if someone is willing to buy the company when it's just an idea, but then doubles down and buys even more when it's valued at $157 billion, well, that means he probably understands this business, and he also understands it's primed for growth. So let's take a look at Ackman's thesis on Uber. And then I'll share some of my analysis and thoughts because, this really has caught my attention. Make sure you stick around to the end of this video because we'll cover Bill Ackman's investing thesis writ large and what you can learn from it as an individual investor yourself. And if you like this type of content, please consider giving us a like and subscribe so we can get this content out to more people. And if this is our first time meeting, hey, I'm David. I'm the founder of flankinvesting.com, and our mission is to tangibly reduce the wealth gap by bringing intelligent investing into the mainstream. We'll discuss more about how we're doing that at the end of this video. Okay, let's dig into Ackman's thesis. All we got was a tweet, but if you really look at it closely, it tells you a lot about what he's thinking about this business. To kick it off, he says he owns 30.3 million shares, which is insane. That's, again, 1% of the whole company. But then his third sentence caught my attention. He's been a long-term customer and admirer of Uber. If you've been following this channel for a while, then you know we talk about this all the time. Invest in the products that you know and love. It's the best way to make money in the market. Personally, my best investments over my 10-year career so far have come from me investing in what I know. That's a very big thing in Buffett-style investing. And then he continues. He said, Uber has suffered from erratic management in the past. That's a really big dig at co-founder and former CEO Travis Kalanick, whom Dara took over for back in 2017, after Travis stepped down due to poor workplace culture. But then he really congratulates Dara at doing a terrific job, and I completely agree. If we look at Uber's performance since 2017, we can see that revenue has grown at a compounded rate of 27%, from $7.93 billion to $43.98 billion just 7 years later. And net income has also been growing wonderfully, going from in the red at minus $4 billion to $9.86 billion in their most recent quarter. And I don't want to jump too far ahead of ourselves because Bill Ackman really cares about free cash flow, but you can see exactly why he's so excited about this. Look at these numbers they're posting for free cash flow gains. 700% in 2023, 100% in 2024. Holy cow, this company's on fire. And you can really see how much Dara has an extreme ownership mentality to Uber. That same day in that tweet, he responded to Bill Ackman, where he said, thanks so much for making a bet on us and super excited to have you on board as a shareholder. And then he talks about how Bill has already called him with suggestions about his service. If you didn't know, Bill Ackman is mostly known for being an activist investor. An activist investor is just a nice way to say corporate raider. They basically buy a portion of the company, get a board seat, and then make people start following the directions. So he's no stranger to giving feedback. I mean, he even continues in that response to that response with some more ideas. One around being able to order multiple Ubers, and the other one saying their tipping system kind of sucks. And then, of course, he responds, love these ideas. This is a great way to respond to an activist investor. No one likes being told how to run their business, but Dara handles this with complete grace. He basically says, oh yeah, thank you so much, while also getting $2 billion invested into him. So tuck that away for your own professional life. But then the second part of this tweet is where we get into some of the meat. He says Dara has done a superb job in transforming the company into a highly profitable and cash generative growth machine. And then he says that they believe that Uber is one of the best managed and highest quality businesses in the world. And then it's remarkable that it can still be purchased at a massive discount to its intrinsic value. I'm really interested in that free cash flow idea. So let's take a look at the hard numbers here. Their current free cash flow is $6.9 billion. So if we plug that in, and then we expect a 15% growth rate, and then we look at the historic price to free cash flow ratio being around 23, and we plug it into our calculator, we can see that just off of that very, very quick valuation, that Uber could be a $500 billion company. That's, of course, with no margin of safety. And I haven't really done my homework, so I don't know if that 15% growth rate is attainable. But if we look at how Uber's free cash flow has grown under Dara's leadership so far, you can see that it's actually not that crazy. Just over the last 7 years, this compounded annual growth rate, which I think is getting messed up because of these negative numbers, Flink is still a young platform, we're working on it. So I just manually calculated it. This represents a 21% compounded annual growth rate. So in my valuation, I gave a little bit of padding at 15%. So if we take away that extra padding and just go to a 20% compounded annual growth rate, then we can see that it should be a $780 billion company. So you can really see how he's calling this thing undervalued. And then if we really go crazy, and we'll go into some of their growth strategies right after this, but if we assume a 30% free cash flow growth rate, then you can see this should be a $1.6 trillion company. I'm definitely not ready to make that assumption, but you can really see just off of this quick back of the envelope math that there's probably something here. And so I spent a lot of time researching this video for what could cause Uber to continue to grow at that rate. And I think that 15%, even just with their core business today, is attainable. Their core business today involve 3 different business units. They have mobility, which is what you think of when you think of Uber. It's ride sharing. And they have delivery, which is Uber Eats. And then they have freight, where they're getting into more of the B2B logistics side of things. And just in the first year, they got $1.2 billion off of that. And delivery is continuing to grow at 18%. And then mobility is growing at a 24% currency adjusted rate. So I'm relatively comfortable assuming a 15% growth rate for free cash flow just on their core businesses. But then that 30% growth rate really got my blood pumping. How could they do that? Well, they need to grow outside of their core offering, which Dara has already started planning for. And the big fat elephant in the room is, of course, autonomous vehicles. Everything in the movement economy is all coming down to autonomous vehicles right now. And Uber's been in the autonomous vehicle game for a while. They were trying to develop their own technology for a really long time, from like 2015 to 2020. But then in 2020, Dara scrapped their in-house plans, and they're going for more of a partnership approach. They spun off their AV division called Aurora. And that's a really smart move because this company excels in being a marketplace. And those partnerships are starting to come into fruition. Uber recently announced that they'll be teaming up with Google's subsidiary Waymo to start giving autonomous vehicle rides in the city of Austin. And what's really interesting here is Waymo has its own app called Waymo One. But inside of Austin, if you open the Waymo One app, it'll redirect you to Uber. And the agreement is Uber will use contractors to clean the cars, do the repairs, and the general depot operations. And they're taking this model into other places. They announced their first international robotaxi service inside Abu Dhabi, working with China's WeRide company. And I really can't highlight how good of an idea this was for Dara, because a lot of companies are competing for autonomous vehicle supremacy. But Uber just stepped back and said, hey, we're a marketplace. Let us continue to be a marketplace. And this helps disarm some of my concerns that I would have. I'm a Tesla shareholder, and I have been since 2016. And the reason why I'm continuing to hold is because I have a Model 3 that has full self-driving, and that is getting very, very good. I wouldn't trust it to be a robotaxi yet, but Elon Musk has been very clear on his plans for that to be the future of Tesla. And that's how they're grounding these crazy valuations of like $30 trillion. But you can see a world where even if Tesla gets to AV supremacy first, well, Uber can just be the market share. Tesla doesn't really have that infrastructure built yet. So in summary, I'm going to wait for things to cool off, and I don't buy things quick. But to say I've been sharpening my pencil would be an understatement. I'm really digging in on this company right now. I've released 4 separate pieces of analysis on Flank in the last 2 days. I'm really going deep on this company right now. But there's one thing that's holding me up right now. And I'll tell you, but check out this video first because it'll lead into it really well. And it also highlights Ackman's strategy for picking companies.
We look for very high quality businesses. What we describe as simple, predictable, free cash flow generative, dominant businesses, a business that Warren Buffett would describe as having a moat around it, right? If you believe that the value of anything financial is the present value of the cash you can take out of it over its life, well, you need to know how much cash it's going to generate over its life. So business quality to us is the single most important criterion for determining what's interesting. Because if we can't predict the cash flows, we don't know what it's worth. If we don't know what it's worth, we can't invest. So we figure out what it's worth, figure out how good the business is, how predictable will this cash flows be from a railroad or a spirits company or a real estate company, shopping mall business. And then we say, okay, well, where's it trading? And if there's a wide gap between price and value, you can buy it for 50 cents, it's worth $1.20. Well, then we're going to take a hard look and try to understand why it trades at a deep discount.
So just like we said, he's focusing on predictable, simple businesses. And when he talks about the high quality part, he's talking about free cash flow. That's very much so Bill Ackman style investing. He really cares about free cash flow. And so there's no question that it's doing that. But the one thing I haven't been able to square in my mind yet is what is Uber's moat? And in the world of Buffett-style investing, that is everything. Now, at first glance, when a company has a verb, I'll Google it. I'll take an Uber. That's sometimes a sign of something called a monopoly moat. But at the end of the day, Uber really is just a marketplace. They connect buyers and sellers. I'm not sure if that constitutes a full wide moat because a competitor could come by and undercut them. But then again, they have competitors that they've been able to fend off for years now, namely Lyft. But I take investing very seriously. So until I'm sure that I can answer that, I'm not going to take a position just yet. But at its core, what Ackman talked about in this process is Buffett-style investing. I mean, he even calls out Buffett by name. And another reason why I know he's a huge Buffett fan is because I've seen him at Berkshire before, which, by the way, Flank will have a presence at Berkshire this year, and we're planning a Friday night meetup. If any of y'all are planning on going, please come say hi in the Discord and let me know. But that part that he kind of glossed over in that discussion, being able to predict the future cash flows, that's actually the hardest part, and that's the key to this type of investing. and it's why it works so well. Computers have a hard time predicting the future. It doesn't matter how strong AI gets. But if a business is sitting inside of our circle of competence, it's something that we're capable of understanding either by our passions, experiences, or any other reason, then we can look into the future of the business easier and we can predict these future cash flows. And this type of analysis is way more different than what's mainstream. I mean, I just got to vent this one out to y'all. In researching for this video, I came across this post from an analyst. And in this article, they quoted Wedbush analysts, and they said that Uber delivered healthy results in Q4, but the setup for Q1 is much more challenging given currency headwinds and the lapping of a leap day and the most recent weather events in the US. Guys, if you are investing looking for Q4 to Q1 and you're thinking about a leap day mattering in that, don't invest. Just dollar cost average the S&P 500. We will lose our shirt every time trying to compete against the hedge funds if we're thinking that short term. My analysis went 10 years in the future. I said, is there a way this company could grow free cash flow for the next 10 years at 15%? You saw how much that will compound if they are able to do that. But if you're stuck in the short termism looking at those kind of things, stay the heck out of this stuff, guys. Just study it from afar, because that's not how you'll make money in the long term. And that's exactly what we're working in direct opposition for. If you're tired of sifting through all the noise, all the short termism, all the technical analysis, all the things that don't play to the strengths that we have as individual investors, then consider joining up on Flank. We're building a community of people who really love to study this stuff and share analysis, because that helps us check each other's blind spots and also think of things we didn't see, or possibly get inspired for a company. All right, that's all for this one. If you want to learn more about how Ackman approaches investing, then we made a video about a year ago covering Ackman's thesis on Google after he bought it. The stock is up almost 100% since he took that position. Thanks so much for watching, and we'll see you in the next one.